It is Friday, November the 26th, the day after Thanksgiving, but we are extending Thanksgiving officially on That Was the Week for a day because Keith's message this week in his Thanksgiving issue is all about thanks. So you have much to be thankful for, Keith, right?
Well, especially you, Andrew. I'm thankful for you.
Yes. You didn't mention me in that thing.
It's true. Can you hear my boys screaming in the background?
I did hear some voice. But...
Yeah, my oldest boy is home from Syracuse, and they're watching Harry Potter in the living room with great audio coming out. So we may hear them in the background today. No, happy Thanksgiving. You know, you and I are both British, so Thanksgiving honestly isn't a big deal to us, but it's a huge deal to our friends here in the Bay Area. So yesterday I had a great dinner with some family friends, but I thought this newsletter this week really had to be about me giving thanks because, as I mentioned on last week's show, my new startup SignalRank got funded. I haven't really talked about it, and so I decided to use the editorial to announce it, to introduce people to the investors and the team there, and then to give some context around what it is and why it's important, and included a couple of articles my wife wrote about the rise of no longer unicorns, but Decacorns. So it's a fairly personal issue this week, as you pointed out.
Yeah, and before we get on to SignalRank and talking a little bit about that, you note that was the week. We're thankful for that too. We have an audience, which is very nice.
Yeah, you know, it's really building up. For those of you listening, this started as a personal newsletter, mainly to my email list, and we recently started republishing the newsletter on LinkedIn, and we've gone over 5,000 subscribers in just a couple of weeks. And on Medium, we have just over 19,000 followers. So it's a lot of people who are finding this interesting in different ways. So it feels really good because it isn't. I'm one of those people that needs to be loved. It's my weakness, and so it's always nice to see that people are paying attention.
Yeah, I'm the opposite. I need to be hated. So Keith, let's talk about SignalRank. I feel like I've been hearing about it for years, forever, because I was, as a friend of yours, I've been in it from the beginning. But very briefly, what exactly is it?
It's an approach to the seed stage of venture capital. The seed stage of venture capital is, I think, the most interesting part of venture capital. It's when smart people make big bets on companies that they do not yet really know what will happen. So it's the most risky.
Even the people at the seed stage companies don't know what's going to happen.
Yeah, it's the most risky stage. And, you know, we know that from the statistics, which is well over 90% of companies that raise seed capital don't ever go on to raise another round. So it's the risky stage. Now, in the world we're living in, and you and I talk about it on this show a lot with Tiger Global and many others, writing very large checks earlier and earlier, actually. What's happening is the seed investor who took all the risk runs out of money very quickly to be able to maintain their holding in a company. As new money comes in, they get diluted. And they usually have the right not to be diluted. It's called pro rata rights, but they don't have the money to actually exercise that right for more than maybe one round. And so that pool of pro rata rights is measured in the billions of dollars annually in unicorns, and nobody's supplying it. So without going into a lot of detail, SignalRank is going to become a supplier of capital to the seed stage investors, allowing them to remain a shareholder at scale in the companies they originally invest in. And we'll share the profits with them on that. So there's an economic incentive for them to take our money. And my plan is to make the seed stage a much healthier stage that has longevity in the best companies, so that the seed investors get rewarded for the risk they took.
Well, to extend the metaphor of the seed stage, are you at SignalRank picking the best stuff? Are you
No, we're not.
hanging fruit? Are you picking the best cherries, Keith, or are you cherry picking?
We're really a little bit different. So, firstly, we do not ever and will not invest directly into companies. What
So
we
you're investing in funds.
and we're not even investing in funds. Actually, it's more complicated than that. We're investing in the managers of funds. So basically, if you are, let's just name some names. If you're Mike Maples at Floodgate Ventures, or Aileen Lee at Cowboy Ventures, or Hunter Walk at Homebrew, or Pat Gallagher at Tuesday Capital, you run out of capital fairly quick, and so you get diluted. What if you didn't? And so what we're doing is supplying capital to those people into their best companies. Now, who are the people? Because we can't just give anyone money. We run some data analytics. We have actually two algorithms. The first is called GP rank, GP meaning general partner. And what that does is it measures how good an investor is at seed investing over many years.
So you're cherry picking the best investors. You're finding
We're finding the best investors. And then we have a second algorithm called company rank, which educates us as to the rules. And so our money has rules. For example, today in 2021, in Q4, the time between rounds for good companies is less than a year. So one of our rules is your company must be raising money in less than a year since the last time it did. Another fact is the money raised the second time needs to be double the first time, because if it isn't, it doesn't give the right signal. So the signal is how fast are you raising and how much are you raising, and then who's investing in you. And we have some rules that Company Rank give us that tell us what the answer to those questions need to be. And as long as the company fulfills those criteria, then Pat Gallagher at Tuesday Capital can take money from us, no questions asked, to maintain their shares in the company through a new legal vehicle that we put in place with him. And it's,
but you're a lender then. I mean, you're not giving Gallagher the money.
We're not a lender because we have no recourse. We can't get it back.
So if you give Gallagher $1 million, where does that money go, and how do you make the money?
Well, he puts it into the company, not us. He puts it into the company.
So okay, so Gallagher you give Gallagher $1 million. He puts the money into one of his companies.
Yep.
How does SignalRank make money?
Well, so that money and the shares it buys are 100% owned by the partnership that we would have with, let's say, Pat Gallagher, and the partnership gives him 10% of the profit. VC funds have what's called carried interest. Typically, it's 20% for a new investment, 10% for an opportunity fund kind of overlay investment. So we are matching the market. 10% profit goes to him, and 90% of the profit comes back to us because we're the source of the capital. And so we make money by, and I should say, this isn't just an idea. I've been doing this for the last 4 years.
You've been doing it. You that's what's interesting about this, is you actually did it before you came up with the idea of it.
Yeah, I did it with Lee Strafford and my other co-founders at ADV, and we put a small amount of our fund on one side to do this. We partnered with Seed Camp, which is one of the best seed investors in the world. We invested in 6 companies with Seed Camp, where we supplied the capital, and our money produced a value of 41 times the money in 36 months. So that's a 4,000% in 36 months.
And you only raised $5 million to start with, Keith. What can you do with that money? I mean, it's going to take some time, isn't it?
Yeah, the 5 million actually is to put in place the company structure. We're doing three things. Firstly, we're building the back office, accounting, and legal framework. Secondly, where Sean Purcell, who is our lead data scientist, is building his team out so that the data science behind this is up, real time and shareable with our investors, by the way. And then the third thing is putting in place the business development team that will go and partner with the best seed managers. And that will
I've
take.
heard a rumor that I'm going to be head of business development. Is that true?
I think you are, Andrew. Yeah, definitely. Another question about
Is
that.
that my punishment?
You've worked with me
If
before.
I'm good, I won't have to be. If I'm well behaved on that was the week, I won't have to be head of business development. Well, it's an exciting.
But I should tell you,
you can't resist, Keith. You are the ultimate serial entrepreneur. Will you ever stop being an entrepreneur?
well, it's in your blood, isn't it? I just wanted to finish the last point about the 5 million. So that 5 million obviously isn't enough money to invest in any partnerships. So what we're planning to do is, and this is a bit audacious, I hope we can pull this off, but I think we will. We're planning to raise possibly as much as $250 million next year to start deploying capital. And as we do that, we'll go on to raise a further 750 million. So it'll be $1 billion altogether. And that sounds like a big sum, but I can tell you the annual need for this product is about $9 billion. So it's a small fraction of what's needed. And then the plan is to do what Sequoia has done, which is this is a permanent capital vehicle. So we'll list on the stock exchange and you'll be able to buy our shares and benefit from the
I'm not going to
underlying
get them for
investment.
free.
Buy our shares.
Why can't I have them for free?
Nothing's for free, Andrew, apart from, Thanksgiving dinner.
And then, so when are you going to become a Decacorn, Keith? 6 months, a year?
When you do a startup, you build a model, and the model kind of tells you what you expect to happen. And the truth is, this will become a Decacorn within about 7 years if the model is correct.
Well, one of the other interesting pieces in the newsletter this week is on Decacorns, the rise of Decacorns, which are $10 billion startups or more. What's the data on Decacorns, Keith?
Yeah, this is work that Jenny Tier, well known to this show, has done at Crunchbase. And she wrote 2 articles. The first was just about Decacorns. This is that article. And what it shows is that the number of Decacorns is 30 this year alone, double last year's number, which was itself 3 times the year before. And increasingly, and these are private companies. We've seen private companies valued even above 10 billion. So there is a scale capability in a private company now driven by really the cloud and mobile. That means you can get really, really big relatively quickly with limited amounts of capital. And so she wrote all about that. So that's one article that is featured in the newsletter. And then the second one drills down into who's investing in these unicorns. And she has a league table with Sequoia Capital at the top. The interesting thing for me is this number here where it says 2.1, 2.3, 4.1.
Yeah.
That's how many times a fund will invest in the company. It goes back to the maintaining and not getting diluted point earlier. These companies tend to do 5, 6, 7 rounds of financing. Most of these investors only invest once or twice. So they're leaving a lot of money on the table when they only invest once or twice.
But that's part of the cycle. I mean, if the early stage investors were investing along the line, then what becomes the point of later investors? They all have a role to play.
Yeah, well, the early stage investors can never dominate, but the way it works is, let's say you buy 10% of a company the first time you invest. And the next time the company raises money, it raises, let's say, $20 million. You really need to put 2 of that 20 million in order to keep your 10%. And if it raises 50 million the round after, you need to put 5 of that 50 in. So the checks you need to write are in the 2 million, 3 million, 4 million, $5 million per round kind of range. But most of these early investors, their whole fund size is under 100 million, and they're just not geared up to keep writing those checks. So it doesn't really damage the later investors if they do. Or on the margin it might, but not really. It benefits the company, it benefits the seed investor, it probably benefits the growth investors as well because of the added firepower. So it's all good.
The economists have dubbed this economy adventure capitalism. You have a link to the piece. I'm not sure if you had a chance to read it, Keith. There's an interesting piece from The Economist about the centrality and importance of the venture business. But as you said, we're on the verge of dramatic transformation, reinvention, disruption of venture itself, which is one of the disruptions is SignalRank itself. So this adventure capitalism is about to dramatically change, isn't it?
Yeah, and it is dramatically changing, although, nothing is that dramatic in venture capital. You measure change in years, not months. But we've talked about Sequoia. We've talked about the rumors that Andreessen Horowitz may list. This week, a British fund that's in the newsletter, Perkin, what's it called? Blanking on the name now. Let me just find it. It's down
here. A law
here.
firm, Perkins Coie.
Not Perkins Coie, but close. Hambro Perks. Hambro Perks. You remember Hambro is the toy company. Hambro Perks is doing a SPAC in London. So we're finding that venture is exploring new ways of existing and new ways of funding and new ways of benefiting from success. So it's changing very, very quickly. And of course, there's many others that are not changing at all. You look at Fred Wilson's Union Square Ventures. I don't see any real impetus for Fred to do anything different than what he's doing today, or any need for him to, because he's really good at what he does. So he's probably just gonna
it's not just him. He has partners, right?
Yeah, not just him. Yeah, I just name him because he's the most well known.
Well, and the other thing is that the one thing that isn't changing in this whole business is you still have to invest. Whatever your investment vehicle is, however much money you put in or don't put in, it's all about believing in a business model. And you have an interesting piece this week in the newsletter about 10 questions you should ask before you believe in the business model. What's that piece about, Keith?
Yeah, I did a whole section this week for founders because there was a collection of really good pieces that this is one of. Another one is why the founder is important to fundraising, written by people at Seed Camp, actually, because founders often get advisors and think that other people can raise money for them. And then another one about how to survive due diligence. But the one you're talking about it's really key to my philosophy, actually. I've never done a startup where I didn't build a business model in numbers prior to deciding to do it. And a business model is a kind of a work of fiction. But the more you understand the moment in history you're at, and the more you understand the world you're going to engage with and the key drivers in that world, it allows you to create a model around key performance indicators that are measurable. And then you say, well, if we do this, that's what will happen, and this is how much money we'll make. And like with Now TV, we've talked about it with Now TV. You and I have talked about, well, if Now TV was a subscription business, what would it look like? How many subscribers? What would we charge? And then you market test that and you see if it's realistic. That is a business model. And these questions are not necessarily the only 10 questions, but it's things like, will a customer stick with you once you've got them? Is the thing they're buying deeply meaningful to them, or is it just a transaction that someone else could do? Can you evolve? over time, or are you stuck with your first implementation? Are you selling against fear or opportunity, which is the pain one? Are there network effects? Is it an ongoing problem, or once you've fixed it, does your business go away? And so on and so forth. Does what you do matter? A lot of these are qualitative, by the way. I tend to do quantitative business models that lay on top of that.
Well, what about, let's move on, Keith, because we're getting to my favorite bit of the show, which is, of course, Startup of the Week. Who is your Startup of the Week?
My Startup of the Week this week comes from a PitchBook story, which gives the league table of the best universities to go to if you want to be the founder of a startup. And,
this is really good.
And the winner is Stanford University, which
Ooh.
has 1,600 founders who've raised between them $76 billion. And second is Berkeley, your university that you were associated with. Let's zoom in here so people can see it. And so the West Coast wins. The move to the East Coast, Harvard and MIT and University of Pennsylvania and Cornell and Michigan are all good. Strangely missing is any mention of Miami.
Surprise, surprise.
Yeah.
Well, you and I, Keith, saw each other at the Stanford-Berkeley game at the tailgate last week. And of course, Berkeley won that. Is that going to change their rankings at all?
Not when it comes to startups, but certainly for football.
And what about the character? Do you think that there is a certain kind of Stanford graduate, arrogant, socially clueless?
I honestly don't know enough to. I'd be caricaturing if I answered that question, because I actually don't know. I think being smart is very helpful, but not enough. Entrepreneurialism is really not about intellect. It's about passion and belief mapped against intellect. And, you do have to be confident, but you also have to be a team builder. You can't just be an individual. The team I've got at SignalRank I'm amazed I could pull that team together. They're all better than I am at the things they do. So you've got to be a team builder, but above all else, you've got to suspend disbelief and make something happen that doesn't yet exist. So I do think that confidence, which comes from achievement, means it's most likely the smartest people in the best universities are going to have a big dose of that. That said, a lot of successful entrepreneurs did not graduate university.
Well, we know that. I mean,
so I actually think if the list included, if that list included didn't graduate, that would be the top above Stanford.
Yeah, so it's best to drop out, as Peter Thiel reminds us. And what about Tweet of the Week, Keith?
So Tweet of the Week is, again, targeting founders. This is from Maren Bannon, who we've mentioned, not for a long time, but we have mentioned on the show before. And she points to an article about what it takes to raise a Series A. And this got my attention because the next thing I have to do at SignalRank is raise a Series A. And she's basically points to this article that puts metrics in place. And by the way, initialized is Gary Tan's fund. Gary Tan's a very, very good seed investor. And he's built this table that says, okay, this is how much you've got to be doing in revenue. This is the total growth that you should be seeing annually, the average order size from your customers, the gross margin, the long lifetime value versus the cost of acquisition, how engaged it is. And so there's all these different things. And then he breaks it down into segments like direct to consumer, enterprise, SaaS, marketplaces. It's very comprehensive. So it's my tweet of the week just because it points to something that's actually usable and actionable by a lot of people. And it's really good.
Well, that was the week for November the 26th, 2021. It was the week of Thanksgiving. Keith gives thanks. We thank Keith. We wish him the best of luck with SignalRank. I'm sure we will talk about it over the years as it becomes a decacorn. What comes after being a decacorn, Keith? A centicorn.
Probably a quadricorn. 40 billion.
And then a trilliacorn.
Could be, if there is such a thing.
Well, anyway, best of luck with SignalRank. Congratulations. Happy Thanksgiving to all our listeners, the millions of people following us now. And we will see you again next week. Have a great week, Keith.
Bye, everyone. Happy Thanksgiving.